restructuring and reorganization. And we've started by saying that we can only restructure, we can only reorganize a company that is not doing very well financially, a company that is financially distressed, a company which is financially distressed. And before we even get to see that between the two, no, they mean almost the same thing. But between the two, there is that way of working it out for our organization, which will entail usage, making use of some court of law, But before we even get to differentiate between these two methods, I would want us, ladies and gentlemen, having the hindsight that we are looking at an organization that is financially distressed. How do we get to measure the financial distress? How do we get to measure the financial distress? The first model is what we call the Altman's. The first model is what we call the Altman's Z-score model. Altman's Z-score model. So for Altman's Z-score model, I would want us straight away to look at a past paper question. And this past paper question, for those of you who have old past papers, they should be able to pick it very easily. It's a December 2014 question number 3. December 2014 question number 3. If you don't have it, you can see it there on your screen. You can see it there on your screen. So what are they telling us? What they're telling us, ladies and gentlemen, is that the following are the summarized financial statements of Shida Products Limited, which is facing financial difficulties. Honestly speaking, you know, the names we call our businesses matter quite a lot. What do you expect when you call a business Shida? What do you expect when you call a business Shida? Shida. That reminds me of a friend of mine. Aliita mtoto namna hiyo, Matahabu. Very good. So, ladies and gentlemen, income statement for the year ended 31st December 2013. I can see the turnover. Turnover is the same as sales. I can see EBIT. I can see interest. I can see profit before tax. Less tax there. I can see retained earnings of 3,000. And then on the same breath, they have given me the statement of financial position. Statement of financial position is given here, and I can see additional information. The corporation tax rate is 30%. I can see the company shares are currently trading at 30 per share at the Securities Exchange. The company's cost of capital is 12%. Interest rate on the bank loan is 12%. And then they have gone ahead to give us the Altman's model for predicting corporate failure, for predicting bankruptcy is there. So that Z-score will always be provided. So we have where they have even gone ahead to give us those ratios. So what do they want us to do, ladies and gentlemen? They want us to compute the company's Z-score and comment on the results. Compute the company's Z-score. Ladies and gentlemen, listen and listen to me very well. Listen and listen to me very well. I would want us to understand this. Which question, Maingi? This is December 2014, question number 3. December 2014, question number 3. Question number 3. Question number 3. Question number 3. So, ladies and gentlemen, here we are. They want us to calculate the Z-score. Anytime you get an examiner wanting you to calculate any Z-score, always think of this model. Whenever you want to calculate the Z-score, always think of Waremas. Always think of Waremas, where this WO will go together, and then we have RE, we have MA, and then lastly we have got what here? S. So basically the Waremas is an acronym which will help us to compute the 5 ratios, And these 5 ratios here are, the WO is for X1, X2 is RR, then we have X3 is E, Then we have X4 is MA. Then we have X5 is S, like that. Now, ladies and gentlemen, listen and listen to me very much. WAREMAS is the most important acronym as pertains this topic, because it is the only value that you can be required to compute WAREMAS, where this WO basically is a short word for working capital. Working capital. This is retained earnings. Retained earnings, retained earnings. This is EBIT. Ladies and gentlemen, we have MA standing for market value of ordinary shares. Market value of ordinary shares. And then we have the last S standing for sales. The last S stands for sales. The last S stands for sales. Stands for sales. So, ladies and gentlemen, the moment I capture these things nicely, the moment I capture them nicely, I can't go wrong. So remember, I want this to be in the form of ratios. So how do I get to change these to ratios? I'll come and say divide, 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 ta, 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 ta. And then the second last is the only one where you use TL, the only one where you make use of the TL. Remember, X4 is market value of ordinary shares. 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 So then I would want us to compute these ratios one at a time. Let's make use of this, or rather we compute these ratios one at a time. We compute these ratios one at a time. We start with the working capital. We start with the working capital. TAR stands for total assets, by the way. TAR is total assets. TL is total liabilities. TL is total liabilities. Total liabilities. Total liabilities. TL is the total liabilities. Total liabilities. So I would want us to compute these ratios one at a time. And I would want us to begin with X1. X1 is the working capital ratio. Working capital ratio. So then the first thing that we would want to do here is to look for the working capital. Can a good student give me the formula of getting working capital? Can a good student give me the formula of getting working capital? Just working capital. A good student to do that. A good student to give me the formula of getting working capital. How do we get working capital? I can see Dennis saying current assets minus current. Thank you, and thank you very much. Most of them have been able to remember the formula. That to get to working capital, we shall take current assets minus current liabilities. Current assets minus current liabilities. Now with my statement of financial position displayed there, with my statement of financial position displayed here, I would want a good student to move with speed and they give me the total current assets. Give me the total current assets here. I'm so sure some students will pick the total assets really. Current assets are here: inventory, trade receivables, bank balance. Is there somebody who is able to see that the current assets here are 375,000? So current assets are 375,000 minus current liabilities. Current liabilities on the same statement of financial position, you'll be able to see our current liabilities here, which amount to 420,000. So minus 420,000. Of course, when I do it that way, I'll be able to get a negative working capital, which confirms the name of this particular company, Shida Limited. Once you have a negative working capital, you'll always be running away from your creditors. from your creditors, because you will be at a position of not being able to pay them. You'll not be able to meet your short-term obligations when they fall due. So negative working capital, that of course is a big indication of financial failure, of financial distress. So ladies and gentlemen, here we are. Come and divide this by the total assets. Total assets that I can see here very first. I'm given total assets of 1266,000. Of 1266,000. So I would want to see whether there is any student who will be able to give me X1. Please, you write there the value. You say X1 equals. You say X1 equals, so that later on when I would want to make some reference, it will be easy for me to do that. Somebody, when you write your answer there, say X1 equals. So my great friend Dennis tells me that X1 equals, I hope you're able to see that figure, negative 0.0355. Remember, for financial distress, you must always give us many decimal places. So after that, ladies and gentlemen, let's go ahead and compute X2. So one thing that I would want us to learn from the word go is that Altman's Z-score model makes use of how many ratios? Five ratios, X1 to X5. And we must be at a position of remembering all these ratios. There is no examiner, that examiner is an old examiner. There is no examiner who will tell you how to compute X1, X2, no. Nowadays, it is you to remember how to compute X1 all the way to X5 using the ORMers. So who can remember the formula of getting X2? Teresa wants us to share this on YouTube. What we'll do is to put it in our website. So X2 from the ORMers. Kindly give me the formula of getting X2. Kindly give me the formula of getting X2 in the ORMers. So X2, how do we get X2? Remember, in the ORMers, WO already gone. So in the ORMers, now X2 will be obtained from R, where we shall say that this X2 will be retained earnings. You divide this by TAR, the total assets. Retained earnings divided by total assets. So I would want you to do me a favor. I would want you to read for me the value of retained earnings. I would want you to read for me the value of retained earnings. Retained earnings. In the, I should share the question with you. So these retained earnings, ladies and gentlemen, should we pick this retained earnings, which is in the income statement of 3,000, or the retained earnings in the balance sheet of 2,000? Because that is the only confusing thing. Which retained earnings should we work with? From the balance sheet. From the balance sheet always. Because when it comes to, ladies and gentlemen, measuring bankruptcy in terms of retained earnings, would want your cumulative. What have you been retaining? That's a clear-cut measure in terms of even yourselves. If you want to know a bankrupt person is that person who does not cumulatively retain anything from their incomes. He gets 100,000, he blows all of it to the wind. So then they will become poor. So in terms of cumulative earnings, this year could have been bad in terms of retained earnings. But now for bankruptcy measurement, we always look at what you have been accumulating in the balance sheet. So we have here 2,000 divided by the total assets. Total assets, ladies and gentlemen, Total assets, which are of course the same. Total assets here, which are of course the same. Masudi, there you are wrong. Total assets, ladies and gentlemen, they are 1266,000. They are 1266,000. So go ahead and give us this figure quite first. What figure are we getting there? And remember how we are writing our figures. We are writing them as x2 equals. So that later on, after I've wrapped mine, so Nerea tells us that x2 is 0.1753 to be consistent in terms of decimal places. To be consistent in terms of 4 decimal places, let's pick what Nerea has given us, 0.1754. Thank you and thank you very much. So after x2, we know that the next one is x3. After x2, the next one is x3. The next one is x3. x3, ladies and gentlemen. x3, ladies and gentlemen. First of all, you must be at a position of remembering the formula, of x3. In my WORMS, WO has been taken, R has been taken. Now we are looking at E. So we have here x3 is an E variable. x3 is an E variable. So what I will do, I'll come and say here, x3 equals E is EBIT. So I'll take EBIT, I divide this by total assets. I will take EBIT, divide this by total assets. EBIT divided by total assets. So go ahead and pick the earnings before interest and taxes. EBIT. You can see up here, EBIT, earnings before interest and taxes, 84,000. So I'll come and take here 84,000. I divide this by the total assets. Whose figure now I have memorized, whose figure is 1266,000. So please say x3 equals what figure? So please give us the figure of x3, 4 decimal places. D Onsongo has given us 0.0664. If you want to be consistent with 4 decimal places, that is what we have. I want someone else to confirm that figure. Is that figure correct? Is this figure correct? Thank you very much. Justin. Thank you very much. Correct. Thank you very much. Now we go to the next one, which is X4. X4, ladies and gentlemen, is quite a little bit tricky. X4 is a little bit tricky. You have to be careful with X4. Remember, X4 is the one of market value. Market value of ordinary shares. And then we'll come and divide this by total liabilities. Market value of ordinary shares divided by total liabilities. So I would want somebody to educate us. I would want somebody to go ahead and give us the market value of the ordinary shares that we have. The market value of the ordinary shares that we have in the balance sheet, we must be having our ordinary shares. So in the balance sheet here, we must be having the market, we must be having book value. Whatever that we have in the balance sheet is the book value of ordinary shares. And I can see straight away here, ordinary share capital, 147,000, and each share is 25. So what I'll do, first of all, I'll get the number of shares. How do I get the number of shares? I will take the book value The book value is 147,000. I divide this, of course, by the par value. Thank you and thank you very much. Josephine already has that figure. The same case with Dennis. So whatever I get here, I multiply this with the market value per share. The market value per share. The market value per share, ladies and gentlemen, we have the market value per share. It's normally given in the notes. The market value per share in the notes. The company shares are currently trading at 30. So whatever that I have here, these are the nodes, number of ordinary shares. But now I need to capitalize this by multiplying this with the market price per share, which is 30, not 35, 30. And then I'll come and divide everything by the total liabilities. Total liabilities, what do we have? For total liabilities, you have to be very careful. Total liabilities, I have the current liabilities. Current liabilities are 420,000. And then I have the bank loan, 183. And then I have the 10% debenture, 294. For your revision, I would want to capture this in brackets. For your revision, I would want to capture this in brackets for 20 plus. So divide by 420,000. 420,000 plus 183,000 plus 294,000. And then you close brackets like that. By doing that, you should be able to give us the value of X4. I'm basically putting those figures in brackets so that you can have it easy when we shall be revising next time. So Maalim, remember to write there X4, because I would want to make reference to those particular figures in a moment. X4, yes, thank you very much. So according to Maalim, we have our X4 being equal to 0.1967, the year that you were born. 1967. Thank you and thank you very much. Now from there, ladies and gentlemen, I would want us to move to the next level. The next level is X5. The last level is X5. We are still working with watermarks. We are still working with watermarks. I've been able to take care of WO. I've been able to take care of R, care of E, care of market value. Now I'm on the last S. The last S is as regards what here? Sales. The last S is S for sales. So S for sales. So come and give us X5, which is an S parameter, sales. So we have here X5. So X5 will be sales. So sales, we go back to our total assets. Sales, we go back to our total assets. We are going back to our total assets. So could you kindly help us? Go back to our income statement. In our income statement, ladies and gentlemen, what are we able to see here? In our income statement, I'm able to see sales hidden there in the name of what here? Turnover. You see turnover is the same as sales, is the same as revenue. Turnover. So the turnover there is 1209,000. 1209,000. Divide this by the total assets, which of course I haven't forgotten, which are 1266 what here? 1,000. Thank you. So could you kindly give me the value of X5? Give me the value of X5. Give me the value of X5. Yeah, Damaris, although she forgot the last thing, but I can see Maalim has it there. You're supposed to write there X5 equals 0.9550, like that. That's X5. That's X5. Thank you and thank you very much. Thank you and thank you very much. Now, the last thing that we're supposed to do is to pick the X values that you have computed, and then we plug them in the Z equation. We plug them in the Z equation, which will always be given by your examiner. So please, now that you have them there, pick them up, plug them in the Z equation, which has been given by our examiner. This Z equation down here. So you take 1.2 times x1, figure that you have in their substitution in this formula given. Remember, the formula will always be given. The Z formula will always be given. The Z formula will always be given. So this Z formula, the Z formula, our Z is 1.2x1 plus 1.4 x2 plus 3.3 x3 plus 0.6 x4 plus 1 x5, like that. And now that you have those figures, it becomes very easy for you to plug them in. And I can see students who have plugged them in. At the end of the day, they have told us that Z is supposed to be approximately 1.4951, like that. Remember our number line. Remember our Z score number line. Our Z score number line, we have 0. We have 0. After 0, we have 1.8. We have 2.7. We'll get some books saying 3, but 2.7 is a defined one, right? And then at the end of the day, what you're supposed to know is that if a company's Z, the actual Z score, falls here between 0 and 1.8, between 0 and 1.8, ladies and gentlemen, here automatically we talk of corporate failure. We talk of corporate failure. Corporate failure, right? In between there, we talk of corporate failure. And then we have 1.8, 2.7. If the Z score falls in between there, we are talking of 50-50, 50-50. So 50% in this case here, failure, 50% success. This is success, success. So listen to me very well. In terms of this number line, anything less than 1.8 is 0 successful. In between 1.8 and 2.7 is 50% successful. Anything which is more than 2.7 is a successful company. A company like Safaricom, if you compute its Z ratio will be quite high. Will be quite high. Okay, great. So in this case here, the company which we happen to be having has a Z score which is 1.4, has a Z score which is 1.4951, which happens to be less than 1.8, and therefore Shida Limited is bankrupt. Corporate failure, Z score. And that is why we are calling it Shida Limited. So I would want you to do me a favor. I would want you, if you can lay your hands, of course, you are accountants of your organizations. If you can lay your hands on your company's financial statements, I would want you to compute your company's Z score. And then you advise your directors accordingly. Calculate your company's Z score, and then you advise your directors accordingly. Advise your directors accordingly. Now, Damaris wants us to repeat this working capital. So the working capital, sorry for that. The working capital Anyway, our working capital, Damaris, basically, our working capital will be our working capital will be current assets minus current liabilities. So you look for your current assets in the balance sheet. Like in this question that you've just done, the current assets are 375,000. 375,000. Minus current liabilities, if you go to the same balance sheet, you'll be able to see current liabilities. Current liabilities of what year? Current liabilities of 420,000, which is a negative working capital, which is a negative working capital, which is a negative working capital. And then, of course, whatever you will get there, you divide it with what year? Total assets. Another student is asking, how did we get X4? X4 from WAREMAS. Remember our WAREMAS acronym. WAREMAS acronym, like that. So this gives us X1. R gives us X2. E gives us X3. MAS gives us X4. This gives us X what here? X5. So, and Pamela here wants us to show her how we got X4. Remember to get X4. Remember to get X4. To get X4, X4 is market value of ordinary shares all over total liability. The market value of ordinary shares, if you look at the balance sheet that we have, they have given us ordinary share capital 147,000. That is the total value for all the shares. So I need to come and take 147,000. You divide this by the par value. The par value given in the balance sheet. The par value given in the balance sheet. Par value given in the balance sheet is 25. And then whatever we shall get, we shall come and multiply this with the price per share, which is 30. And then you divide this now by the total liability. So I hope I've answered you. And of course, you also have an opportunity of watching this video in the website. Watching this video in the website. In the website. Right. Now, ladies and gentlemen, listen and listen to me very well. Other than the Altman's model, do we have other models that can be used to measure bankruptcy? Yes. So the other models which I would want you to take into your notes here. The other models which I would want you to capture there are these ones. So mention model number 2 before model number 2. Model number 2 is called the Beavers failure ratio. Beavers failure ratio. Ladies and gentlemen, Beavers failure ratio is a single factor model. Unlike Altman's, which makes use of 5 ratios, Beavers ratio will be using, ladies and gentlemen, only one X factor. And to get the X factor here under Beavers ratio, we shall be taking the operating cash flows, and then we divide by what here? Total liabilities. You take operating cash flows, you divide by total liabilities. Ah, great. So, ladies and gentlemen, one thing that I would want you to understand about Beavers. To calculate Beavers, you will simply go to your cash flow statement. Leave alone the investing cash flows. Leave the financing cash flows. You will go to your cash flow statement and pick the investing and pick the operating cash flows. Once you have your operating cash flows, realize that your cash flows from your operations are, say, 300,000. And then your total liability happens to be $1 million. So this will give me 0.3. So 0.3 is less than what here? Is less than 1. 0.3 is less than 1. And anytime you have your ratio being Beavers ratio being less than 1, then that is an indication of a struggling farm. Beavers ratio can only be good whenever it is more than 1. Any farm whose Beavers ratio is more than 1 will be a firm that is able to collect more from its operations in comparison to its total liabilities. Its total liabilities. Its total liabilities. Right? Now, ladies and gentlemen, listen and listen to me very well. That is, as pertains what here? The Beavers ratio. Nothing more, nothing less. So if your examiner asks you to describe the Beavers ratio, just remember, it's a one-factor model. And this factor is operating cash flows all over what here? Total liabilities. All over total liabilities. We go to the second model, third model, I mean. The third model, ladies and gentlemen, the third model is what we call the famous Zeta model. Zeta model. Now, Zeta model is basically an extension of the Z ratio. The Z model. Ladies and gentlemen, listen and listen to me very well. I'm saying here that anytime they want us to calculate, not even calculate, anytime they want us to describe the Zeta's model, Zeta's model, just like the Z, ultimate Z model is a quantitative model, is a quantitative model which is an extension of the Altman's, Z-score model, an extension of the Altman's Z-score model. It uses seven factors to evaluate the extent of corporate failure, the extent of corporate failure, the extent of corporate what here? Corporate failure, the extent of corporate failure, the extent of corporate failure. And ladies and gentlemen, remember that Zeta model is a proprietary model. It's a model that was coined by Altman's, et al. and others, which is available to anybody who is willing to do what? To buy the model. Otherwise, the model, even myself, I've never seen it. So I'm only supposed to know this description. Yeah, it's an extension of what here? The ultimate Z-score model, and that is it. Once you have that idea, then every other thing, corporate failure. And I would want us to read this together. We are told here, this is the most notable qualitative model. It's called Argenti's A-score model. So Argenti suggested that the failure process follows a predictable sequence, which I would want you to rewrite, there. So Argenti suggested that the failure process follows a predictable sequence. Number one, there must be defects within the organization. This includes management weaknesses, such as an autocratic chief executive officer. Defects, very, very important. When defects are there, number two, we shall make mistakes. So mistakes, this will occur over time as a result of the defects above. Ladies and gentlemen, from there, number three, we have symptoms of failure, the cracks now. The mistakes will eventually lead to visible symptoms of failure, e.g. deteriorating ratios or creative what here? Creative accounting. So, ladies and gentlemen, what are we saying as pertains Argenti's A-score? As pertains Argenti's A-score model. Argenti's A-score model. So Argenti's A-score model. Argente's A-score model. The very notable thing that we have always to mention about Argente's A-score model, ladies and gentlemen, is that it is a qualitative model of predicting corporate failure, qualitative. And it normally, or rather, the process, a firm's failure, according to Argente, is normally, or rather this firm's failure will go through three processes, where the first process we've been told there is the defects process. So process number one, defects. And they have given us, ladies and gentlemen, the first defects, lack of internal controls. The first defective item, which will exist in most of these companies here that fail. Number one is what the examiner is calling an autocratic CEO. Autocratic CEO. So a CEO, for example, who does not want to be told anything by anybody. Those people who know it all, those are killers of institutions. They are killers of institutions. Remember what we normally teach you in SGE, that you should never have any individual in the company who is a Mr. or Miss know-it-all. Where the person, for example, overrides. He is the one who is running the show in the company and again in the board. Where you have one individual who is both chairman and, for example, CEO. Once you have a dictator even for a president, straight away that will be the beginning of a failure of that particular country. That's number one. Now, number two, ladies and gentlemen, once we have defects up here, the second thing that we expect to culminate here will be the mistakes. So mistakes automatically will arise. Now that the managers have not been able to put internal controls, things will start disappearing up there. And when they start disappearing up there, the same managers now will go ahead and tumble down, make mistakes. And some of the mistakes, as we're told here, some of the mistakes here that they have told us there, ladies and gentlemen, is the concept of, for example, overtrading, where in this case here, you want to show the public that you are doing quite a lot. And in essence, you are doing, at the background, you are simply doing nonsense things. Look at, for example, Suraya. Once Suraya got themselves in problems, they started now, trying to embellish everything that they're doing. That's overtrading. When you are trade, like whatever you're trying to expand, the speed at which you are expanding cannot be financed by internally generated revenues. Right? The internal generated revenues cannot finance your expansion very well. Right? Ladies and gentlemen, the other mistake, of course, will be the overgearing. Because now we have messed up. We don't have really liquidity internally of our own here. What do? We simply approach banks and we start borrowing heavily. That's another mistake. And then, ladies and gentlemen, the last one is what we call the symptoms. The symptoms now. The cracks will start appearing. The symptoms, of course, the first crack will be when the board of directors calls you as an accountant, telling you that it would want you to window dress. So window dressing of accounts. Window dressing of accounts. That automatically, ladies and gentlemen, will show that the company is not doing very well. The company is not doing very well. Is there anybody who has any question before I finish and then I come back to the two questions here? I'll send you this handout, so please don't really labor to write so many notes, and I'll send you this handout immediately after this class. So from there, ladies and gentlemen, we have the last model, what we call the TAFLA and the T-shows model. TAFLA and the T-shows model. So when we talk of TAFLA and the T-shows model, the most important thing you're supposed to know under TAFLA ladies and gentlemen, is that it is a quantitative model which makes use of 5 ratios. 5 ratios. 5 ratios. No, 4. Therefore, the CO is a constant. So 4 ratios. Unlike the Altman's Z-score, Tafla, and the T-shows model make use of 4 ratios. 4 ratios. Again, you can never find this model anywhere, nowhere. It's a model which is available for sale, and for that matter, it's an expensive model. It's an expensive model. It's a very expensive model. Now, so I've finished, ladies and gentlemen, describing how to evaluate corporate failure, and I would want to come here this very keenly. So when we talk of a sell-off, what will happen for a sell-off? You will get a company like, for example, Safaricom. If Safaricom, in this case here, feels that they have some shares which are not sold. At times, it's always good to have shares that you reserve. So if you feel like you want to sell these shares, the extra shares that you have, like 20%, 30%, to the public or to whoever who wants them for purpose of us raising new capital, then automatically whatever you are doing there is a sell-off. So here we are basically selling shares. We are selling shares here, say to third parties. Under a spin-off and a carve-out. For spin-off, ladies and gentlemen, we'll have to split our company. So for example, we have Safaricom. We could have Safaricom, in this case, here split into 2 companies. So we have here Communications Limited, and then we have M-Pesa Limited. For example, Safaricom has spinned off to 2 different companies like that. What will happen, ladies and gentlemen, out of this new company or companies that have been created? This process can only be called a spin-off if they are owned by the same shareholders. I mean, if Safaricom disintegrates today, who would want to be left in this company? I'll not even agree to this particular kind of an arrangement where M-Pesa is drifting away and it goes. I can only agree into this kind of a separation if I'm also going to be an owner in the new company. The shareholding do not change. So under spin-off, how it spins like this, but always gets back to the old owners. So you're simply spinning it off. Reasons why do we want to spin off? Why do we want to split this thing? We want to split it, for example, to have a true market value of the shares of the company. You know, like right now, if you take the current market capitalization of Safaricom is a huge thing. The only way that they can make the public and of course the world at large to understand that Safaricom shares are reflecting the truthfulness of what is on the ground is to do like what Equity Bank did, share split. So they can decide in this case to split their shares into 4, like Equity Bank, into 4, right? Or they can even decide like now there is a serious advocacy. Some people saying, no, Safaricom, for us to be able to know the true meaning of Safaricom, let's have M-Pesa going away. So if M-Pesa goes away, spins out, and then spins back, of course, getting back to its old shareholders, then automatically that will be what here a spin-off. And of course, when we are spinning off like that, even if we are spinning it off the old shareholders, the company will have to get some money. So it is a restructuring process. It's a restructuring process. And then, ladies and gentlemen, we have a carve-out. A carve-out, again, here we are going to have a new company. For example, we could decide, in this case here, to have a new company called M-Pesa Limited. But for a carve-out, we shall simply carve out something very small for outsiders. We shall carve out something very small for outsiders. Basically, if it is M-Pesa, I could say 60% goes back to the old owners. And then we have, ladies and gentlemen, 40% being bought by who? By outsiders. And of course, whenever we release this 40% to outsiders, our company will be getting what here? We'll be getting money. We'll be getting money. So what am I able to understand? When we talk of sell off basically whatever we are creating out of our old company, everything will be sold off to third parties. Spin off, we create a new company, but ensure that the new company is owned by the old shareholders. Under a carve out, we'll create a new company, yes, but relinquish shareholding, minority shareholding to the public. We relinquish minority shareholding to the public. We still control this like a subsidiary. We control this subsidiary like that. This was tested just the other day, this concept here. And so many students here returned scripts, in this case, which were blank. Okay. So management buyout, quite confusing. Management buyout. What do we mean with this management buyout thing? So when we talk of management buyout, basically the current managers who normally see a lot of potential in a company, because they're the ones who are running it. So the current managers buy out existing shareholders. So basically, it is an acquisition. It is an acquisition of a company by its managers. So like now the current managers we have at RCM, most of our shareholders are outside there. So if it reaches a time when the shareholders they will say, hey, now is not the time to invest in the education sector given this COVID thing, and then they decide to run away, the current managers may say, hey, no, don't just close the school, sell to us the shares. And of course, they'll end up buying those shares at a very reduced price. That is what we call what here? Management buyout. And Tony put it very well. Actually, Tony has put it in a way that I can't even put it any better. Tony tells us management buyout is when managers of the company buy ownership of the company. When the current management of a particular company buys the ownership, buys out the existing who? Shareholders. Ladies and gentlemen, how about in this case here management buy-in? This is what you normally see the cadres of Chris Kirubi doing every day. They simply look for troubled organizations like TransCentury, ETC, Centum, ETC. They look for those companies which have got a huge potential. Like we saw how Chris Kirubi ran to Kenya Airways. Just the other day, he bought so many shares of Kenya Airways. So basically his intention is after the management relinquishes Kenya Airways, something that they have been trying to do. Yeah, they sell their shareholding of Kenya Airways to the public. Chris Kirubi will be among those few individuals who will be having so many shares. Then that means automatically that him, and of course his firms that he used to buy those shares, will have taken over Kenya Airways because they know for sure that Kenya Airways is a big company. You know, Kenya Airways is the pride of what here? Africa. But because of mismanagement, people who are from outside who have got management expertise like Akina Chris Kirubi, now they are working in the company, they take over control of the company, and then of course they manage the company. So here we have under management buy-in, these are basically managers. experienced managers who are coming from outside, experienced managers who are coming from outside to buy a controlling stake over a company, to buy a controlling stake over a company, and then they do what here? And then they run that particular company. So they are buying in. They are coming from outside, come in and buy a controlling what here? A controlling stake. You can see like what Peter Kinyumu is telling us. I like that. He tells us MBI, external management team acquires a company and its operations and replaces the existing management team. I can't put it any better. Yes, that once we have Akina Chris Kruby coming and taking in Kenya Airways into their management, automatically they'll come and vote out all the existing directors. Because now these guys are coming with their own people, Very good, very good. Now, ladies and gentlemen, still under this, although not directly in the topic, I've seen these examiners asking, we describe for them what we call the bootstrapped acquisitions. Bootstrapped acquisitions. Bootstrapped acquisitions. So could you kindly, ladies and gentlemen, try to define this for us? Bootstrapped